let's go through an actual case study to show what this looks like in practice. These are actually real numbers here from a client that we helped who was sold a really bad policy and some of the things that we changed. So same client, same health, and these different scenarios we're going to go into, same premium, but by changing how the policy was structured, able to change the commissions by reduce the commissions by $89,568 and generating $79,025 in incremental year one cash flow. And more importantly, added $907,920 in additional tax-free income over 20 years. So this was a client that came to us. They were being proposed an overfunded whole life policy. Then before they actually signed the paperwork, we had people that we trust that max blend their commissions and that set these up in a fiduciary way, take a look at it, and there were some massive changes here. So let's go through the 4 pillars of buying life insurance like a billionaire, Jim. So how about you take us all through those 4 steps?
Sure. So the first is underwriting. And usually what happens when an entrepreneur buys life insurance is the agent shows them a proposal, presentation. And by the way, the illustrations, I can tell you, are 100% never true. I've never seen an illustration 30 years later that actually came true exactly the way it was proposed. So they see an illustration, they get pitched the idea, they like the idea, they buy the whole life, and then the agent puts one application with one provider because it's best for an agent to work through just a small number of providers. That way they get trips, they get better commission schedules. It does help them know the product better. But you'll typically see an agent that's really making their living off commissions will just sell 1 or 2 or maybe 3 products. So then it goes off to underwriting with one company. Whatever the underwriting comes back is how they put it into force. And the problem with that is the underwriting of the policy stays with the insured for the life of the policy. So it's an enormous difference if you got, let's say, standard versus preferred or preferred plus versus preferred. Those make an enormous difference in the cost of the policy over the lifetime of the policy. So what Billionaires do and what we recommend and what we do with our clients is shop the different companies because different companies have different underwriting for different circumstances. And so the best way to do it is you take the entrepreneur, you take a application, you get the blood, urine, EKG, whatever you need to get for that size policy. You send it to 14 different companies as an example. You put John Doe and Jane Doe on the applications. They have all the medical testing. It's the actual person, their blood, their urine, everything else, all the test results, and then they come back with their offers. And you get them pitted against each other. And you'll see that typically if you do 14 different companies, you'll get 2 to 4 different levels on the underwriting. And just 1 or 2 differences on the underwriting conclusion can make a huge difference on how that policy functions. So then when you come back, you pick the one that works best. It's already been underwritten, and then that's what you would put into force. That's the underwriting. Blending, this is probably the most impactful thing because we've already talked ad nauseum about the huge commissions in life insurance. So this is really negotiating down the life insurance commissions. And what a lot of entrepreneurs don't know, a lot of people don't know this, is that commissions can be negotiated. They can do what's called blend the policy with non-commissionable insurance, which reduces the amount of commission paid. And I've had people say, no, you can't do that. I've had insurance agents tell me, no, you can't do that. And I say to the insurance agent, well, maybe you can't do it. But there are insurance agents that can do it and will do it if we're going to work with them. Number 3 is the internal charges, the cost of insurance, admin fees, surrender charges. Those change between carriers, so you also want to look at that. Lower internal charges means more of your money working for you. And then 4, the investment choices. Are these sub-accounts? Is this a dividend paid by the company? Is it an interest rate that's declared by the company? Is it a cap with a floor that we talked about earlier? Understanding what are your investment choices? What does that look like for your long-term performance within the policy? And those are the big 4 when it comes to actually putting together a policy that's going to work for you rather than working for the agent and for the other insurance company.
So putting this in practice and tying those 4 different variables back into this example in this case study here, we'll put a chart up here that's going to show you 4 different variables. So there was an unblended policy, and then there was the blended policy that we drove through our providers that we recommend. Again, we have no compensation. We have no skin in the game here. But the agent commission was going to be $112,600. Instead, the agent got paid $23,032. So that was an $89,000 difference, 80% reduction in agent commission. So what does that do? That impacts the cash value year 1. So in an unblended policy, as you mentioned, the life insurance company said, well, I already paid this agent all of this money. I got in $100,000. I paid out the agent $112,000. there's no money here for me if you want to walk away from the policy. Whereas when it's blended, well, since a lot less money went out the door to the agent commission, then that means there's a lot more cash value year one. So you can see that represented from $0 to $79,025. And then where this gets really powerful is tax-free income, because this entrepreneur was designing this as a tax-free pension. So they wanted to put money in every single year, let it grow and compound, and then maybe at some age, let's say 65 through age 85, pull the max amount out via a loan, which is not taxable, and then they'll never have to pay that loan back because the death benefit will pay off the outstanding loan at their death. So in an unblended policy, they would be able to pull out $277,000 per year versus $323,000 in the blended policy. So that's a difference of $45,000 per year of after tax, tax-free money, right? So that's a substantial amount. And if you just aggregate this together over 20 years, which is the last row we've got here, it's an incremental $907,000 of after-tax money. So a few simple tweaks. You go through that 4-step process that you talked about, but the difference here, and this was an entrepreneur that was going to put $100,000 a year into the premium, and again, was going to walk away with almost an extra $1 million of after-tax cash in their pocket when it's all said and done.
Wow. Amazing. One other comment as I think about this whole life insurance thing. You really want to make sure that whoever you're working with, if you buy life insurance, that they're going to be around, or somebody's going to be around, or their company's going to be around. And here's why. A lot of entrepreneurs don't realize that if you take out your basis, then you're taking loans against the policy. And let's say you do that when you're age 30. Let's say when you're age 80, that policy collapses. All the loans you took out for all the years are taxed in that one taxable year. So you might be an 80-year-old that gets a big surprise when you go to see your accountant and do your taxes the next year. So that's why these things have to be managed carefully and watched, and these have to be reviewed on a regular basis. And often I meet entrepreneurs and they have a permanent policy. They put a lot of money in it. I say, when's the last time you talked to the agent? Oh, I haven't talked to the agent in 10 years. That's a problem, because these things can blow up way down the road and cause a huge tax problem.
Yep.